Regular viewers of the show will know that I am not a big fan of gold. First of all, it pays no interest, unlike other financial assets where you get paid something for holding it. And what's more, it's got a negative carry. In other words, there's a security risk with gold, and often it costs you money to store the stuff in a bank safe vault or something. The only really good thing about gold, in my opinion, is that it's great for pretty jewelry. Who can be against that? And particularly in countries like India, they're very, very keen on gold jewelry and collect it as part of a dowry, young woman that is. Okay, so it shouldn't come as a surprise to you that I consider the current gold price to be a bit too high. Yes, it's been driven higher on thin volumes, sometimes by speculators and other gold bugs. The people who think that the world is going to end, and you're going to be pushing your shopping trolley down the street with shattered buildings all around you, and the only way you're going to be able to pay for a loaf of bread is with gold coins. Please. Even more challenged are the South African gold mining companies. And I must be careful here. Look, these guys built this nation. The gold sector, the gold mines were the backbone of the South African economy from the 1880s right through until about the 1960s. And the surpluses created in the gold mining sector helped stimulate the industrial sector around it, and the tax revenues helped fund the state to do all the infrastructure development that led to the modern economy that we have now, with all of the finance and the tourism and all the other retail and other sorts of sectors that we have. But frankly, now it's past its best. High costs, deeper and deeper mines, lower and lower grades, worker injury claims, rising electricity prices, health and safety dilemmas. It makes this a tough, tough sector to be in. However, the largest and best SA-based gold company is AngoGold Ashanti. It's got a market capitalization of about 140 billion rand. It's got mines outside of South Africa, like in Ghana, with high margins there, and globally it's probably the best positioned gold mining company. So when I was in New York City a few weeks ago, I went and caught up with Stewart Bailey. He's a South African, but he is the Vice President of Investor Relations in North America, where his job is to market that company as an investment for American investors. So let's take a look.
But I manage investor relations for AngoGold Ashanti. We're South Africa's largest gold producer. I focus on North America in particular. It's where 52% of our shareholders currently are, and where most of our liquidity is here on the New York Stock Exchange.
So next I asked him where in fact the share price was determined. Is it here in Johannesburg, or was it based really in New York, where the big traders and the buyers and the sellers are?
We do about twice the liquidity here in New York than we do in Johannesburg. So as much as a lot of the sentiment gets driven out of Joburg, the price certainly gets set here in New York.
So next I asked him who in his job he actually targets. I mean, are these the big global asset management funds, or is he really only interested in the sort of gold bugs, the guys that are holding, buying, selling, trading the gold shares?
Our principal focus is long money. We don't have a particular focus on gold bugs per se. I think our focus is split amongst emerging market funds, mining funds, gold funds, growth funds. So we're not particularly fussy. I think our story resonates with a fairly broad swathe of the market, particularly at the moment where people are looking at different ways to play the gold trade. So, it's a good time in the market for us right now.
One of the next questions I asked him is something that comes up a lot, even amongst people who are positive about gold, and that is that it's better to own the gold ETFs. That's gold exchange traded funds. Here in South Africa, it's got the share called GLD. In America, there are a couple of the different gold ETFs. Because people say, yes, I want the gold exposure, but I don't really want to get involved with the dramas and the dilemmas of the gold companies. At different times in the past, people have said, no, you can't buy the bullion, you've got to buy the companies, because those are the ones that really score when the gold price goes up. But in markets in recent years, there's been a big shift into owning the gold exchange-traded funds, and I wanted to get his answer as to why, in fact, it was still worth looking at the companies themselves.
It's difficult to argue against people who've made up their mind, but what you do have with the ETF is undoubted. It's doubtless an easier way to play the gold trade in that you don't carry the geological risk and the management risk and various of the other risks that you get with any equity investment. But at the same time, you don't have the leverage that you get from the gold companies, and from ours in particular, where with the rising gold price, you're obviously getting good cash flow, good earnings leverage, and you get yield as well. And we increased our dividend this week, so from being a fairly paltry dividend payer we switched to quarterly dividends. We're now yielding more than 1%, which, you know, looking back from where we've come from, it's quite a chunky increase. We've doubled our dividend over the last 2 years.
That's a great point, because obviously, I mean, the ETF has a holding cost, or if you're going to go and actually hold physical bullion, you've got security or other negative carry.
Absolutely, and you know, the negative carry aspect is something that you should focus on. But at the same time, gold companies have been notoriously bad in the past in managing their capital, and in they haven't been the best custodians of shareholder value. And what we've done over the last 3 years is systematically looked at turning that around by managing our capital more efficiently, increasing our yield, and you know, showing some cost-effective growth. And I think we've scored on each one of those things so far.
Interesting. The last question I asked him is, how is the market today different to the way it used to be?
It's strange. I came to New York just on the day that the first Bear Stearns subprime fund collapsed. And, you know, I think the market was in denial for the first, you know, from 2007 until 2009. Then it became enormously risk averse in the intervening, you know, from 2009 till midway through 2010. From my perspective, although I don't, you know, I'm not an active market participant, you know, in that, you know, I don't manage any money, but certainly talk to a lot of money managers. What I can see is that in the general investment universe here is that the market is taking on an enormous amount of bad news and shrugging it off. And, you know, that for me is a fairly worrying sign, because you get a sense that the other shoe has to drop at some point. And, you know, that's certainly, I'm coming at it from a gold perspective. I think that in the end is probably positive for gold, but won't necessarily make it a nice world to live in.
Well, he makes a pretty good case, and the question really is, what happens next? There's the AngoGold Ashanti price over 5 years. See, it hasn't really done that much. But on the other hand, you know, maybe this is the time when it's going to start looking a little bit more interesting.